the criticism will be.
Hello and welcome to the FX debates here in London at the British Museum. With me is Mr. Michel Del Buono, who is a global strategist at Makena Capital Management. Hello and welcome.
Hi.
Thanks for being with us today. We're going to talk about currency wars. And I'd like to know if how the US is involved in this currency war.
Yes, so I think what's interesting about the US in the currency war framework is that the US is really much more focused on domestic issues. And one of the big issues with the US is the accumulation of debt in the US. In fact, if you look at all the promises they've made for healthcare and retirement, the US is about 50 trillion, and that's a conservative estimate, some people say as much as 100 trillion, of commitments. I don't want to call them unfunded liabilities because they could potentially change the rules. And so that means that there's going to be a lot more debt accumulation in the future, even with the recent tax hike. And so I think the policymakers are going to eventually have to be focused on reducing the real value of that debt. And that's one of the reasons why I think they're doing these extraordinary actions to try to sort of weaken the real value of the debt in the long run.
So let's talk about the Fed's QE program. It's been quite controversial, but do you think it's worked?
Has QE been working? I think it's worked very well in the domestic economy. And you can see in what's happened with domestic growth, it's been quite good in the US. How sustainable is it? It's driven by both central bank action and also, of course, very, very large deficit spending in the US. Deficits are in the order of, well, they were 7 to 8% of GDP. They're going to fall, but the long-term number seems to be around 4% of GDP. So a lot of fiscal and monetary action has been helpful for the US.
And who has been the biggest winner in currency wars?
I think if you look up to this point now, I think Germany's been actually one of the winners of the currency war. And that's because in a fixed exchange rate regime like the Eurozone, having below target inflation, which is what Germany has, is equivalent to a competitive devaluation. Because what it means is that your costs are lower than that of your neighbors within your currency zone. And Germany has had below target inflation for a long time. Obviously, that's not the whole story. Part of it is that the other nations have had above target inflation, so that their unit labor costs have been rising rapidly, while the Germans have been not rising fast enough. So there's going to have to be adjustments on both sides of the table. But certainly Germany so far has done very well as a result of that. The euro is much cheaper than it would be if it were the Deutschmark.
So how can you make the most of this currency war as an investor?
The best way to play from an investor's point of view, if you're worried about the real value of money and of assets, a good place to put some of your assets is real assets. Sorry for so many words saying assets, but I think real assets, the definition of real assets is an asset that everyone in the world agrees upon its value, no matter what currency it's denominated in. So think a barrel of oil, for example. It's worth something to everyone in the world. If the dollar is weaker, it'll just be priced more because everyone else in the world wants it and is willing to pay the real value of it. So real assets can be anything from commodities to real estate to farmland, things that hold value no matter what the exchange rate is doing.
Thank you very much, Mr. Del Buono.